All right, we are back for another version of Equi Market Call International Edition. Itay, where are you located right now?
I'm in Tel Aviv, Israel.
Itay's in Tel Aviv, Israel, and I'm melting continuously under intense heat right here in Central Texas. Thank you, everybody, for tuning in. We have a lot of great things to cover today, as we always do, help you better understand markets. Just wanted to quickly introduce ourselves. Give a little context about what we're doing, and then hand it over to the star of our show, Itay. So we are Equi. You can think of us as the first digital family office. So we are a one-stop shop to get a diversified basket of the best alternative assets all in one place. So you think alternatives, that is exactly what we do. We've had some really great performance, which I'm sure Itay can talk about a little bit later. But this is the type of portfolio that would require somebody to have hundreds of millions of dollars. And Itay, we've done it for substantially less. Is that correct?
Much, much less. I would say it's 100x better than anything that existed prior.
Big, bold statements in the house. So I want to give you a quick background for everybody who hasn't tuned in before. We have Itay. Itay is my co-founder here. I'm Jeremy. I'm going to be the host, moderator / question asker for everybody today while we're kind of doing this asynchronously. Itay's background, he's been in ultra high net worth over Beverly Hills, where he saw how billionaires invest during major market downturns of 2008. He has run a non-correlated hedge fund to the markets that traded some pretty sophisticated strategies. He's been a precious metals market maker. He's done a lot of different things, and he is now your CIO over at Equi. So Itay, do you want to just say a quick hello, and then we can hop into it?
Yeah, it's great to be here, and I'm excited to cover today's content.
Sounds great. You got to give one thing that you like about me before we start, because it just wouldn't be fun if we didn't have that too.
Are you kidding me? You're the parking spot master, right? So you got to tell the story of how you made $1 billion in revenue from, what was it, $7 parking spots?
Yes, for another story at another time. But thank you for the compliment. We are going to talk about the future today. So with that said, Itay, do you want to hop into the content that you have, and we'll just have a nice little dialogue about what's happening in the market?
Yeah, let's do it.
Let's do it. And I got to give it to you. Your slides have gotten a lot better looking over time. Evidence.
I can't take all the credit for that. There was some of it was our designers. So I would say all of it was our designers. I've never understood Figma. I'm staying with PowerPoint. That's all I can say.
As long as your market insights are still good, then we're okay with it.
Okay, so as you've mentioned well, we're Equi. We make elite investing accessible. Today is July 11th, 2022, and we're going to cover today's market update. Again, market update, July 11, 2022, and let's start. So last time when we had the market call, it was about a month ago, and we're around here in the S&P, and we're asking this question: is this a bear market rally that's just going to break out to new lows, or is this a sustainable dip that we can buy? If you remember, this was prior to the option expiration for June, which was a really large one, and was ahead of the CPI report, which a lot of people thought that inflation has peaked already, and therefore they were expecting the market to rally. As we all know, inflation came in hotter than expected, market broke apart, and then we had the Fed raising rates by 0.75% versus the expected 0.5%. So we find ourselves in a very similar place today, with the S&P just trading below 3,900, slightly lower than that prior peak. And we asked ourselves the same question: is this just another bear market rally? As we've seen, all the prior ones were roughly 9 to 10% in size. 9% there, 11% there, 10% there, and roughly 9% now. And we're going to try to answer that question. Spoiler alert, the answer is most likely yes.
All right, I like spoiler alerts.
This is the bear market of 2000 to 2002, a very vicious train wreck that took place. It took it a while to really fully materialize. What is really interesting is you can count the number of bear market rallies, some of them massive. Look at this one, 22%, 26%. And you had over 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 bear market rallies during that time, very large ones. And what's interesting is that the largest parts of the decline actually came at the end of those bear markets, where people fully just started throwing out the towel and capitulate, and just start selling. And the largest one was really at the end of that bear market, which you had a consistent down 34% with almost no counter rally during that time at all. So when you think about that anatomy of a bear market, just try to realize that you could have numerous bear market rallies while you're still in a primary downtrend.
How does this hold up to past, if you go even into even into the 20th century? Is this similar mechanics that happen?
Yeah, it's incredibly similar. 2008, I would say, had fewer bear market rallies because it was just shorter. But also remember that the global financial crisis was the beginning of Fed and government intervention in both the TARP program, the first QE, and a lot of injection of capital into the economy. So I think now is a little bit different because you're actually seeing the opposite. So it is more similar to, the 2000, 2002, or maybe the 1970s, very similar.
Okay, thanks so much.
Sure. So we're in a very similar situation again, where on Friday we have an option expiration. Now it's not going to be as big as what we had in June, where once we broke the 4,000, if you remember, we warned about a break of 4,000 would probably trigger a substantial sell-off because of dealer hedging. That's kind of exactly what happened. The July expiration is smaller in size. It's not as big, but at the same time, a break of 3,800 in this case would likely cause further downside, while the resistance is around 4,000. So I would say I wouldn't get excited over the market unless it breaks through 4,000 in a convincing manner for a real bottom in place. So those are the numbers I'm watching.
And what's the date that we're waiting to see that number?
It's not really within a date because it's a concentration of open interest over many cycles. So if we start seeing volume coming in, call buying coming in, call buying actually supports the market because of the way options work, but we're just not seeing that yet. We're not seeing any of it. We're seeing institutions just sitting on their hands and nobody's really committing to this market. Okay. Another interesting insight is these indicators that I follow. The VVIX is the volatility of volatility. So it's the VIX of the VIX. And TDEX is the skew indicator for equities. So what is skew? Skew is the premium you're paying over further out of the money options versus at the money options. Why is it so important? Because historically, during big market bottoms, we're seeing people freak out. And when they freak out, they go 15, 20% out of the money, and then they start buying protection really far away. Because they're like, oh my God, the market is crashing. It's going to continue to crash. I might as well just buy hedges that are 20% out of the money. What's really interesting in this sell-off is that we're actually seeing skew below 2020 levels, way back to 2019 levels, and nobody is actually buying out of the money protection at all.
So what does that mean then?
It means that most puts that are being bought are close to the money, and it seems that the market is not really, it's very orderly. It's just falling in this gradual decline. There's no panic. It just tells me there's no panic. And if you look here, for example, March 2020, you can see the panic. Everybody's trying to grab that skew. And in other market sell-offs, we've seen that too. So it's just difficult for me to see this bear market ending without this climax in selling, without this total panic mode, which typically is associated with big market bottoms. We just haven't seen it yet. Okay,
so you're waiting for the final capitulation, but there's no place in sight for that, is kind of what you're getting at.
Yeah, I'm just saying, like, historically speaking, that's how markets bottom, and we just haven't seen it yet.
Cool.
Okay. Another indicator I've been tracking recently is the euro dollar exchange rate in purple here. And you can see it this year versus the S&P 500 futures. We've just made new lows in the euro. It's just trading, I would say, pennies within parity with the US dollar, and just made new lows for the year. Typically, that has led the stock market as well. So again, when I'm looking at those indicators, the currency markets are very important for me. I want to see some kind of stabilization in the dollar exchange rate to lead to some stabilization in the stock market, but so far it's just making new lows. Interesting too with the dollar yen. We've tracked this one. The yen just made new lows again as of today, 137 versus the dollar. Here you see its correlation with the TNX, which is the US 10-year yields. US 10-year yields surprisingly have somewhat disconnected from the yen over the last few trading days as yields have actually moved back lower. So it remains to be seen whether or not we're going to see yields blow up to new highs, or is the bond market telling us something else, that they're diverging, possibly because it's starting to price in a recession. Okay, so what are our July catalysts right now when we're looking at what could potentially move markets ahead of this option expiration? So we have our CPI data coming in July 13th. We'll touch about that in a second. And again, the question that we ask every month, has inflation peaked yet or not? Retail sales come out on July 15th. And that's a really big one too, because we have a 70% consumer economy. We want to know, is the consumer still strong? Option expiration is on the 15th, VIX expiration on the 20th, and we have the Fed meeting on July 27th.
These are some big events happening.
They are, and they're definitely going to be moving markets. So inflation is likely not peaked. We're going to analyze those one by one. In our last CPI reading, we had 8.6. If you recall, market expected 8.1. We had this big negative surprise because inflation shocked everybody to the upside. It's actually expected to come in at 8.8. I would think that anything lower than 8.8 may cause a market rally. Anything above that may be problematic if it's not priced in already. But one of the big motives here is that the market is still not, after the shock of last time, it's actually not expected to peak, at least not in July.
Itay, what's happened, just as a quick reminder to everybody, at the last few readings of CPI? How has the markets responded in the past few months?
Yeah, so especially the last one saw a massive sell-off. I want to say 8%, 9% in a very short period of time, maybe even 7% in just a few days. As basically we surprised to the upside, and the Fed, that was supposed to raise rates by 0.5%, put it up to 75 bips. So we had a massive 75 bip rate increase that completely shocked the market and caused June to be an incredibly negative month. I think the S&P almost dropped 9% in June.
And when we talk about 75 bips, let's just be clear, that's 0.75 percentage point on the return of 75 basis points. So it's just our shorthand of how we say things. 3
rate increases is one. I mean, we're really living through historical times. You really have to study history to appreciate it, but it's truly unbelievable to just be in a front row seat in one of the most incredible times, I think, in market history.
Thank you.
Here's what worries me when you analyze the CPI data. So what you can see here is the CPI broken down. You have the headline number that was 8.6% last, and then you have your goods, your food, your energy. Energy here is in green, and there's a lot of talk about inflation because of energy prices, right? Oil is high, gas is high, but what I'm worried about is actually the services part, which is if you take out the energy and you take out food and you just look at services, not even goods, it's 3% on its own, which is 1 point over the Fed's target. And what's very worrisome to me is that services is the most sticky part of inflation, because once you increase your prices for different services, it's very difficult to take it back down because these prices tend to be extremely sticky.
Do you want to give an example of something that might be a commonly held service that we might see that feeds into the CPI?
Yeah, I mean, I'm going to give you an example. Imagine, I'm going to go very simple. Imagine somebody mowing your lawn and takes their price from $50 to, let's say, $65. They're doing that because they have to pay higher wages. And they're doing that because the cost of fuel and maybe the cost of supplies have increased. But wages is the stickiest part. So once the wage increases, it almost never comes back down. And that is what makes that type of inflation exceptionally sticky.
Got it. So if the Fed is even trying to have a 2% minimum target, and now all of a sudden you have wages in at 3%, you have no room there, because this is not really going to go down, is what you're getting at, right?
Right. So even if energy start coming back down, and we'll cover that in a second, that doesn't necessarily mean that you can really lower inflation just with that, because inflation is a type of thing that once it really comes out and it becomes ingrained, then it's incredibly difficult to sustain it. And I think this is the reason the Fed is acting so aggressively.
Got it.
And here you can see for the July 27 meeting, there's actually a 93% probability of another 75 basis point hike. So I've never seen anything like that, obviously, and I don't know when was the last time we've seen things of that magnitude, but back to back, month after month, 75 basis points. And then what's interesting is that there's a 7% chance of a full 1% rate hike. There's not even a lower probability of anything lower than 75 at this point. Okay. So a large drop in oil could in fact lead to inflation peaking. So again, peaking means that it's not continuously going to 9, 10%. Okay, it's falling back to 7, 6%, but it still can stay elevated for a while. And why do we think that? So if you look at metal prices or metal miners, they typically are very correlated with oil, as metals tend to even lead industrial metals and things of that sort. We are seeing the metals dropping already, and oil has not dropped nearly as much. Oil has stayed relatively elevated. So that's one potential indicator for oil to drop. When you're looking at open interest in the NYMEX and the New York Mercantile Exchange versus the price of crude oil, usually they're pretty correlated, but we are seeing relatively low open interest right now, as there's just less interest in trading. That could lead to a price decline. There's less interest to do business at this price.
And Itay, can you just talk about open interest again? What is it?
It's really a measurement of volume in the futures contract. So if you look at volume in stocks, open interest in futures tend to be just a way to measure volume.
So if there's low volume, doesn't that also then mean that prices could move more drastically as well, because there's not as liquid of a market?
Yes, it's true. It just seems that there's less interest to do business at this price level.
Okay, I understand. So is it waiting for a lower price or a higher price?
That's TBD, right?
Okay. Guess so.
Another explanation could be that hedgers have already hedged what they needed to hedge, and now they're not doing it anymore. I mean, remember that futures are different than equities, where hedging activity is a very large segment of the market.
Mm-hmm. That's right, because you would have BP or you have an airline that has to buy jet fuel, and if they're not consistently hedging their book, then they're going to have wild swings in the underlying price of their good, which makes their business almost impossible.
That's right.
Yeah.
Another thing to consider is the dollar index, right? So remember that dollars and oil tend to be negatively correlated because oil is priced in dollars. So that means that if you have rising oil and rising dollar at the same time, it means that oil actually has gone up even more on a relative basis to accommodate for the increase in the dollar value. So imagine if you have to buy your oil in another currency like euro, right? Then potentially you're suffering way more because you're taking a hit on both your currency and the increase in the value of crude. So what you're seeing here is that the dollar has been on a tear recently. It's been really on fire, and we've seen crude oil still maintaining a high level. Another indicator we're looking at where it comes to crude oil is the recession indicators. So they are now flipping negative. So when you're looking at oil supply demand, things like miles traveled, they're starting to drop. So it means that people's demand for crude oil is starting to fall as well. So during a recession, when demand falls, that the price of oil typically falls as well. So again, it's not in deep recession territory like you saw here in early 2020, but it just flipped to elevated risk when you look at all these type of factors together.
Yeah.
This is one of the interesting slides I've seen. If you think about 2008, 2009, we've had a little bit of a commodity and crude oil boom at the beginning. And then we had oil going from, I think it was 140 all the way to 20 or $30 in a very short period of time. The 10-year yield collapsed and CPI collapsed as well. So when you get a really steep recession very quickly, it could in fact collapse inflation and CPI. It's just something to consider. Because, I'm not saying that that will happen, but inflation could collapse very, very quickly if you do fall into a deep recession.
If that did happen, what would be the market's response? Would they be happy, and would that be good for equity prices, or would that be like how would the market respond?
Yeah, that's exactly my point. My point is that everybody wants lower inflation now because they think it would be positive for the market, but that's not necessarily the case. I think it's the rate in which it falls that matters. So if inflation starts falling gradually and the labor market becomes strong, still remains somewhat strong, that's a positive. But if inflation collapses very, very suddenly because of a collapse in demand, then that's actually not good for equities at all. That's going to signal that we're going into a really deep recession.
Okay, so be careful for the very quick drop in inflation. That could be signaling of something, a greater problem.
Right. So if we saw inflation going from 8.9 to 7% and then like 4% in just 2 or 3 months, that would be incredibly negative in my opinion.
What would be the wind down period that you'd want to see in a healthy economy to go from, like, let's say 8.5 down to 2? How long are we talking that should unfold over?
I think 12 to 18 months. That would be the quote soft landing type of scenario.
Okay.
Yeah. So again, this is another thing to consider, is that even if that inflation rolls over, if energy rolls over, inflation could stay elevated with, some prices are sticky and will never revert back potentially. Now, one of the things to consider, we have covered those currencies in a bit. The dollar index rate of change this year has been close to 15%. That is historically an extreme. And if you recall the call we've done over the dollar and the petrodollar system and how the dollar impacts the entire world's economy, it's one of the most interesting things to realize, because almost every period in history we've seen the dollar increase in a very short period of time led to a lot of problems for the world, whether it was the 2015 here, Chinese devaluation, the Eurozone crisis, the global financial crisis, the tech bubble. Now we're seeing similar levels of dollar strength.
And so let's talk about that really quick, because when you have a fast rising dollar, this means that every country that is buying things in dollar denominated currencies, or now have taken, let's say the emergings that have taken debt in dollars, there's now a quantitative tightening effect where it requires more of their home currency to be able to just service that debt or buy that product. So it really kind of acts as almost like a catalyst for recession in those type of markets. Is that a fair thing to say?
That is correct. And then it eventually impacts US earnings as well, as we'll show in a second, because the US now is comprised of many multinational companies that do a lot of business outside the US as well. So the consumer outside the US gets hit really hard, especially buying US products.
So basically right now, what's good for the dollar index is allowing you to do your European travels. It's a pretty good setup, but ultimately hurts a lot of people involved.
Yes, exactly. And eventually what the world needs is a weaker dollar, but then, it can't happen when the US has high inflation and the Fed raises interest rates faster than everybody else and actually reduces dollars by going direct QT.
And it could also be a trigger for the ECB and some of these other central banks to have to raise their interest rates. Is that really kind of?
Yes, but we'll cover the ECB in a minute, because it's not that easy for the ECB to do that because Europe is in such a mess. So
yeah, I'm excited to talk about that. I've been thinking about the ECB and the European Union for the past few weeks, so I'm really excited about it.
Fascinating topic. Okay, so you can see actually that the dollar index here, that's the year over year inverted scale. So if you take the dollar index rate of change and you invert it, it has a very high correlation with the S&P 500 earnings revision. So how analysts revise it up or down. So you could see that periods of very strong dollar lead to negative earnings revision. And now we're going through one of those periods of very strong dollar, which is likely to lead S&P earnings lower. Lower S&P earnings typically lead to lower equity prices too. So, it's kind of a chicken and an egg problem. And this is why it's kind of a known thing that a strong dollar doesn't tend to be very positive for equities. Talking about the euro dollar exchange rate, this is one of the JP Morgan currency models that they're looking at what a change in the implied growth means for the euro dollar exchange rate. So right now the euro has undershot the implied growth by about 3% or so. But if we go through a Eurozone recession implies the euro dollar exchange rate to be close to 90 cents, which would put even more upside pressure on the dollar. So not only you'll see it at parity, you will see the dollar potentially 10% stronger.
That is surprising. Let's see how this plays out.
Okay, so let's talk about that ECB trap. For a minute there.
You want to talk about who the ECB is again for everybody that's not always tuning in?
Yeah, so the ECB is just the European equivalent of the Fed. It's the European Central Bank, which acts in a similar way with monetary policy in the Eurozone, which they impact the money supply, as well as the their equivalent of the Fed fund rate, which is the European depository rate. The biggest difference, of course, is that the Eurozone is a monetary union, but it's not a fiscal union because they don't share a single government. And that is the biggest difference.
I understand.
So in order to understand that, I think it's important to just generally understand the system that we're in, which is a credit system. And in a credit system, the party must go on. What do I mean by that? You need to have growth all the time. And if you don't have growth all the time, that's a big problem for a capitalist economy because especially in a debt-based economy, because then you go into a deflationary spiral. And that's the equivalent of, the 1930s depression type. Nobody wants that. So as a part of the system, the accumulation of debt is actually bigger than the entire economy because there's more claims on the economy than there are things in the economy that can support that claim. That's really how the debt system works. It's kind of crazy, but when you really dig into it, you understand that that's just how it plays out. And the problem with that, like we've seen in 1929, is when there's too many claims on the debt at the same time, and everybody wants their liquidity at the same time, that's a big problem for the system. So that's what central banks consistently want to avoid. And you can see that in this chart, where you can see the GDP of the world versus M2, money supply versus the base money, and debt is really, you think about it as IOU notes or claims on those things. So there are way more claims on GDP and money than there is GDP and money to support it because debt is spread out across time, right? But
so what if we have a major downturn in GDP and this debt turns out to be worthless? What the heck happens?
Then you get a depression like 1929 and then in the 1930s. This is, again, what the central banks want to avoid. We almost got there in 2008, but then what they did is flooded, liquidity into the system to avoid exactly that. And this is the worst enemy of the central banks.
But don't they then just fill the system with even more debt? Doesn't this just fast forward? Doesn't this just make it even a higher likelihood that we go into a depression because there's more debt in that system?
Well, not necessarily, because if economic growth accelerated to a higher pace to support that debt, then you wouldn't actually have that problem. The problem is if you flooded it with debt, but then you don't get the economic growth to support that type of debt.
Okay.
So central banks actually have been predictable for many years, because if you think about it, when there's sluggish economic growth and there's a recession, what do central banks do? Everybody knows it, right? They lower interest rates to stimulate debt, and the stimulation of debt actually increases demand, right? Because they want to avoid the deflationary spiral. But then if the economy is too strong and you actually get inflation, what do? They raise interest rates in order to lower demand and then cool off the economy. But everybody knows that the system is always going to be bailed out in case of deflation. It's always going to happen. It's been going on for years. And therefore, the drop in debt levels every time interest rates rise is less and less and less. So you get to a world where debt gets accumulated over time and interest rates always go lower. That's what we've seen over many, many years. And you can see that in this chart where you, on one hand, you see the Fed fund rate going to 2020 and then the corporate debt levels. So even though you have those cycles where it goes up and down over time, the total debt amount just continues to increase, but then the interest rates continue to go lower. And then you get to the point that it's at zero and there's not much it can do anymore. And that's where we got in recent years.
And is there a cap to where interest rates can actually go, knowing that a good portion of our economy nowadays is literally debt that the government has to pay interest payments on? Is there like a subsistence level of where we hit that, we're now giving 50% of our revenue collections from taxes out to debt, or we hit an unsustainable level?
Yeah, so that's exactly the big question. Nobody really knows what that is. But the crazy part about all of this is that up until now, even though the debt numbers have massively increased, the total percentage to serve those debt hasn't for years because of interest rates. Interest rates have continued to decline. And that's exactly the trap of being in this type of system and having so much credit and continuing to expand credit. So the question is now that we all have to ask is this really it? Is this the moment where something really has to happen because it's become unsustainable? It's a very difficult question to ask. So during basically the last 4 decades, the increase in debt was offset by those reduction in interest rates. So the cost of servicing the debt hasn't gone up. But now we've gone to a point where the spread between inflation and interest rates is just absurd. So even now, when rates have gone up to 1.75, you can see it visually with inflation in 8.6. And you can see the difference between the inflation rate and the Fed rate. And you can go back to the 1970s, and you can really see that we've never had such a disparity between inflation and interest rates. And again, why is that? Is because you have too much debt. If you raise it to those levels, the government won't be able to service that debt, right? You answered that question earlier. You can see that with the ECB is even worse. So European inflation just hit 8.2%, which usually Europe have lower levels of inflation, and their rates are still at zero. So they took it from negative to zero.
Oof, unbelievable.
And their balance sheet is incredibly high as they've printed a lot of euros in recent years. And they don't have a plan of how to get out of it. There was an interview just recently where Christine Lagarde from the ECB was asked, how are you going to get it down? And she says, well, it will come down in due course. In due course, it will come down. There's no answer. They don't know. They just don't know what to do at this point. They don't know how it will come down. And I think the difference is to understand that Europe is a monetary union and is not a fiscal one, right? So the US can print dollars, Japan can print their yens, and the government can influence the central bank as they normally do. But Italy, as an example, right? They can't demand the central bank to just print euros for them. They can't do that. France can't do that. They are dependent on a multi-country system, and each country could have a different set of incentives. And that's really the main problem for Europe. Also in the US, you have the same entitlement system, right? You have the same social security system. You have the same federal tax system, the same national defense system. None of that is true for Europe.
But so if I was sitting in the United States, wouldn't it actually be worse to have this unilateral print? Because you then have a central government that has sway over the Fed, and then can basically use the money to fund whatever programs they want, exacerbating the problem. Am I not doing this through the right lens?
No, believe it or not, it's not as sustainable, and you'll see why. Because the U.S. can create its own money to basically monetize the entire debt because it's all unified. Because this is the debt levels are not held by the states. they're always held by the federal government, right? So you can see the debt to GDP of individual states. Those are the highest. So like California, New York, for example, only have 5% of their state debt to GDP, right? But compare that to Europe.
Wow. So we're talking state debt to GDP in this in the United States, we're talking at high 8%. But if we now take a look in these European countries, a number of them are over 100%.
And why is that? Is because you don't have a centralized, there is no Euro bond, right? There's a German bond, there's a French bond, there's an Italian bond. There is no 10-year treasury for Europe. There is no such thing. It has to be held on the individual country level. It's like having, you know, a 10-year California treasury. You don't really have that because the federal government is the only one that is allowed to do that. And that's where that fiscal union makes the United States dollar and the US economy a lot stronger and less fragile than the Eurozone. The Eurozone is substantially more fragile because it doesn't have a true union. It just has a monetary union. And then each country has very, very different set of things that it needs. So as an example, right, the US states never need the debt, the Fed to monetize their debt to stay solvent. The US federal government may need that, but the state level doesn't need that. And some European countries literally depend on the ECB to stay alive, to stay solvent. Like you can think of Greece and Italy, they require that. There was just recently an ECB meeting where they were talking about monetizing Italian debt again. So the ECB doesn't just have the monetary problem. Think about it. The Fed has an easier job. They just have a monetary problem to worry about, but the ECB has a political problem too. And you can see that in this following chart, the way the Italian debt has been monetized going back to 2004. So ECB QE starts after the Eurozone crisis. And at this point, the ECB is effectively monetizing the entire Italian debt. If the ECB stepped away as a buyer of Italian debt, Italy would default. They're 100%.
The ECB is literally the only buyer of Italy's debt.
Correct. And that's why the 10-year Italian yield is at 3.14% even after these increases. It's
So
basically the same as the US 10-year treasury.
So if the ECB stopped buying Italy's debt, their interest rate would go through the roof. Is that safe to say?
Right, because they're not stable, and that's why the euro is in a world of hurt on top of what the Fed is doing.
Very interesting.
So this is the problem in Europe. So I think that, you know, this is not a new problem. Obviously, this has been a known problem for a long time. And in 2011, 2012, when you had the ECB, not the ECB, when you had the Eurozone debt crisis, you had the famous Mario Draghi coming in and saying, whatever it takes, we will keep this union together. We will buy all the debt. And they've done that, right? They've monetized it to the trillions and trillions of euro, and they have kept it for a while. But the question everybody should be asking is, how long can that sustain itself if they don't have a euro bond, if they don't go into more integration? And the problem that you have in all bear markets is that all the fragilities of the world get exposed because liquidity becomes problematic and all the problems surface all over the world. And this is one I'm watching closely.
So is this something where almost like how Greece had a default and well, I don't know if they had a default, but they needed a bailout, and how Portugal needed a bailout. Could we see this on a more mass scale throughout Europe, where a lot of these European countries really have to go through kind of a setback?
Well, when that happened is when the ECB just started bailing them out using QE to buy their bonds and monetize their bonds. So they haven't really needed it because preemptively the ECB has just been buying their bonds like crazy. That's the only reason you haven't seen it. The problem is with inflation of 8 or 9%, which we haven't seen in the Eurozone, can they continue to flood liquidity with the QE programs while inflation is running this hot? And that is why I think Europe is in such a mess.
Yeah, and sorry, I know we're going a long time on this slide, but if they're at this level of inflation right now, what happens when Russia kills all nat gas coming up? And now we have winter coming up, and winter in Europe they're almost entirely dependent on Russian nat gas. So what what does that mean for inflation? This could be bad.
Yep. This is why I'm not very bullish on the euro.
Okay, well, I'm taking up your space. You're the lead here. I apologize. Keep rolling.
No, this is 100% correct. I was going to talk about exactly that. This is why I think it's potentially the riskiest place for the EU since the euro debt crisis, possibly more. And I think that the entire resolve of the eurozone and maintaining the single currency is going to be tested. And then hopefully, I'm hopeful that things work out with gas and long-term solutions with LNG. But the last thing that Europe needed right now is a war on its eastern flank. Okay, so let's go into our topic that we'll wrap up with. And I hate being all doom and gloom on these calls, but we've had to do that over the last few months to kind of bring the awareness of what's going on in the global economy. Unfortunately, being defensive proven up to be the best position to take, but this is just the way to present reality. But again, this doesn't mean that you don't get one of those big bear market rallies or even larger moves. And of course, things can improve at any time. But I do think it's important to present with the catalysts or why things are so important or why things could potentially sustain on the downside as well. Okay, so in the US, I think it's important to realize that the stock market is truly king. Specifically, the US stock market is king for the world. The US is 23% of global GDP, but the US stock market is 61% of the global market cap. It's completely unproportionate to the size of the US economy.
But wouldn't the market cap be more of a reflection of the expected growth and the earnings of the underlying companies? So they may not be as big, right? But if your profits are really good, wouldn't that justify having more market cap?
I think that the market cap of the US is a reflection of the perceived safety, right? Because people are willing to pay substantially more for US companies than, let's say, an emerging market company because it's in dollars and it's in the United States, and they trust the property rights, and they trust the capital, and they trust the earning system, they trust the gap reporting and all those kind of things. And that over time compounds with the US being the primary place of investment, even for corporations being offshore. Like even the Norwegian sovereign wealth fund, right? The majority of the stocks they buy is in the United States.
Yeah.
So why is this a good and a bad thing? The US economy is very reliant on consumer spending, as we've mentioned before. It's roughly 70% of the economy. And a stock market drop could cause a pretty substantial negative feedback loop in the entire world. And it impacts the growth of different companies and also earnings in places in both the US and abroad. So what do I mean by that? You can actually see the stock market impact on the economy has never been bigger because the market cap to GDP ratio, this is the so-called Warren Buffett indicator, right? When he thinks that, or he used to think that when the market cap of the stock market becomes 100% of GDP, then it's expensive. Well, now it's 200% of GDP.
And Itay, is it 200% of GDP even with the most recent fall in the market?
More or less. I think is maybe a few months ago, but it's not totally different. Maybe it's a little bit less now. It was at least an all-time high, but think about it in a logical term. Imagine the stock market drops 25%. It basically would wipe away 50% of GDP in terms of purchasing power. It doesn't mean GDP obviously drops 50%, but it means that that amount of wealth has disappeared. So if GDP is, let's say, $20 trillion, you have potentially 10 trillion of spending power that just got wiped out. So it's very impactful.
Got it.
And how did the stock market become so important? It became so important because of decades of low interest rates. So when you have low interest rates and you can't get, you can't get 6 or 7% on your 10-year treasury, you're going to pursue riskier assets in order to get that growth. So you've seen this negative correlation between interest rates and equities. Obviously, the higher the interest rates, they compete over the risky assets. So that has held for a while. Prior to this recent drop, we've seen valuations reach extremes that were very close to what they were in during the tech bubble. That trend of higher valuations generally has accelerated after the global financial crisis, because after the global financial crisis, for over a decade, rates have been consistently held below inflation, which that's a new phenomenon. That wasn't the case prior to 2008. So again, we've basically really expanded the valuations from what the historical norms have been. And the lower interest rates, in my opinion, also have contributed to a big structural shift where money went from active investing to passive ETFs and Vanguard funds and things of that sort over decades, or at least over the last 15 years. And we see trillions of dollars getting into passive. So now you have these automatic 401ks, you have companies like Betterment, you have all those kind of things that just push into US stock indexes. And all that creates a situation where, for the first time here in 2021, the percentage of US household assets held in stocks exceeded that of real estate. So the largest source of wealth for the average US household was no longer their house. It was actually their retirement portfolio or 401k or their equity portfolio. And that is potentially, in my opinion, a problem.
Why do you feel that's a problem?
Because real equity prices are more volatile than real estate prices, and they're more liquid as well. And you can actually psychologically see their prices every single day, where there's no ticker on your house that tells you your house lost $2,000 today. Imagine if there would, right? People would go absolutely crazy. So if you lose a lot of money in paper wealth, it immediately impacts your consumer spending and your spending habits. And in an economy that's 70% based on consumption, it could actually cause a negative feedback loop, because then you're going to start spending less, and kind of the prophecy of a declining stock market becomes real. And then you actually start getting real negative earnings, and actually it becomes this negative reinforcing cycle.
And then they start seeing their portfolios go down, and then they sell, and then the margin kicks in. So a lot of downward potential. Are you seeing a lot of areas of potential downward pressure on this type of market?
Right. So that's exactly what that creates. So it's interesting here in the 1980s and even into the early 90s, when interest rates were high, the percentage of wealth in equities were sub 10%, and look how much was in real estate. And this year is the most famous real estate bubble, right? That peaked here in 2006 or so. It's interesting that since the end of that bubble, roughly 2010, even though real estate prices have gone up, they haven't gone nowhere near those levels. It's actually been replaced with equities. And this is why I do think it's something to consider, because, you know, my personal opinion, obviously, and I think it's complicated because there's also inflation to take into account and other things. But when I look at consumer sentiment, which is a very important indicator because it impacts, you know, what people are planning to purchase, and in a consumption-based economy, it's really important. It just hit an all-time low. Notice at 50, it got to 60 in 08-09, and now it's at 50. So consumer sentiment and what consumers think about the economy and what they're planning to make their purchases, the University of Michigan consumer sentiment hit all-time lows. I think that the drop in equity prices, alongside with this inflationary pressure and everything becoming more expensive, probably is a big explanation of why that is, because equities are so much more meaningful now than they ever have been.
Cool.
So again, I think that US stock market now has the most influence it ever had. So, you know, the Fed is in a difficult position where they're forced to raise interest rates into a declining stock market. And then the stock market is having these ups and downs and bear market rallies. If we do want to have a stable economy and a good recovery, maintaining the stock market has become a very, very important thing. If we do see further declines in the stock market, I do think it can leak into the real economy in a more meaningful way than it ever had before.
Well, Itay, you've done it again. You gave some really good insights. We appreciate it. And thank you for making time halfway around the world.
Thank you so much. I really enjoyed it as always. And, always reach back out if you have any questions, and look forward to seeing you guys again soon. If you do have any questions, feel free to write us an email. I'm sure the link would have the proper email to reach back out, and we're happy to answer.
They can always reach us at founders@equi.com. You can also go to equi.com and apply for early access. I know we're getting toward the end of it, but we now have a list of almost, I think, 2,500 people. So the people that are tuning into these calls who like what we're doing, it's the type of person that we really resonate well with, and we want to, help them get started with us.